October 1997. Two Nobel Prize economists had a hedge fund printing 40% returns a year every major bank wanted in. 11 months later, those same banks were forced to bail them out or watch global markets freeze. The fund was called Long-Term Capital Management. John Meriwether launched it in 1994 and raised $1.25 billion on day one, the biggest hedge fund start in history. He hired two Nobel Prize economists and built a model that could predict market moves. The model worked. 1995, up 42.8%. 1996, up 40.8%. They were so confident they returned $2.7 billion to outside investors to keep more of the profit for themselves. Here is where it gets dangerous. For every $1 of real money, they controlled $25 in bets. A 4% drop would erase 100% of what they had. And the pile of contracts they were holding was worth over $1 trillion on 200 people. One office building in Greenwich, Connecticut. Derivative exposure equal to roughly 10% of the entire U.S. economy. August 17, 1998. Russia defaults on its debt. The model never planned for a moment when everything crashes together, bonds, currencies, stocks, all around the world, all at once. LTCM lost $550 million in a single day. Over the next month, $1.85 billion gone. Their $7.3 billion in equity had collapsed to $600 million. September 23rd. The New York Fed called 14 banks, Goldman Sachs, JP Morgan, Deutsche Bank, a $3.625 billion bailout in one afternoon. Alan Greenspan told Congress this could have caused global markets to seize up completely. The model was not wrong because it was stupid. It was wrong because it was too certain. It had never seen a moment where every market panicked in the same direction at once. Certainty was the blind spot. You run this same trap. Every time someone says their system never fails or the model says it is safe, that is the LTCM mindset. The smarter the model, the bigger the thing it is not accounting for. 3 rules from this. 1. Never borrow to invest. Leverage turns small mistakes into total losses. 2. When something sounds too perfect, ask what it cannot handle. 3. Boring wins. Index funds. No liberty. The Nobel Prize winners lost 92%. The boring options survived. If this kind of story makes money make sense, subscribe. New financial history every week. Real stories. No jargon.